Good morning and welcome to the IG Morning Report from Australia. Very, very interesting times waking up to this morning over here. It has finally sort of come about that the markets are really waking up to what's going on in Washington. We've now entered day 3. It certainly doesn't look like they're getting any closer to any sort of resolution on the shutdown and the budgetary impasse that we currently have on the continuous resolution. And that is really starting to get people to spiking up and also thinking about what's going on with the debt ceiling. Last night we saw Treasury and particularly Head of Treasury Jack Lew coming up with a very, very big broadside to both sides of politics, basically saying get on with it. He basically came out and said that if they weren't to raise the debt ceiling come October 17 and the $16.7 trillion that comes due on that it will have ramifications that are absolutely unknown and could have GFC/almost Great Depression ramifications for the US and also the globe. He said that also the way you've got to look at this is that in the short term there is other issues that come about that come for generations, and that is higher interest payments, higher debt repayments, a slowing economic growth. We also could see a situation where repayments from the Fed also start to struggle. And considering how long the Fed has been working very, very hard to stimulate the US economy, this would be a massive step back. And all of this broadside came about by the fact that it doesn't look like there is an impasse on Capitol Hill. The Republicans are certainly seeing massive fissures and fracture lines really starting to come about, and with John Boehner still talking about, yes, the budget impasse, but we will pass the debt and default ceiling very, very soon. It still hasn't made the markets very, very secure about that. The way that we've quantified this and really started to look at it, there is a T-bill that is actually due on the 24th of October this month, and it should be, under theory, returning to face value as it comes towards the end of its life and actually gets paid on face value. Looking at the risk premium that were attached to that and the coupon payment that comes with it, it is spiking and it should be going the other direction. It's currently jumped up roughly about 25 bips. It's currently sitting at around about 14 to 15 points, and that is a real massive change, which is exactly what we saw in 2011 back in August when they had the same debt ceiling idea, and it does suggest a very, very high level of volatility in the underlying market. Although we haven't seen it probably in the equity markets, the currency markets are starting to move. And at the moment you can see the US dollar is under a fair amount of pressure, particularly from its major currency structures that you want to have a look. Have a look at the euro. The euro's now got to an 8-month high against the US dollar. And this morning we see Goldman Sachs coming out very, very strongly and putting a short on the dollar yen. And the yen looks like the place to be. It is really looking like it will ramp up as the run for safety happens. The other thing we've got to talk about is obviously where all the credit sits. If the US does default, and let's say it is an if, you've then got to ask where the cash reserves that they currently have, not the credit they've got, will be paid. And you would assume they'll pay the military, they'll pay Social Security, they'll also pay Social Security payments and benefits, pensions, etc. They will be the ones that probably see those cash reserves exhausted and put into the local economy. Therefore, if you're a debt holder of a Treasury bill or any form of Treasury of the US economy, you are going to find yourself under pressure come the 17th of October. Most of that sits in China, and if you're a holder in Beijing, you'll be getting very nervous. What that obviously means also for us here in Australia is that you've got to have a look that if the Chinese start to get nervous about how the US is operating their current finances and start shedding out Treasury bills, US dollar will start to plummet. It will put risk on the shelf, and that means as a risk economy and also a risk currency, the Aussie dollar and the ASX will probably start to slide. We've already started to see it in the commodities yesterday, and the more and closer we get towards the 17th, it's going to ramp up. And with the Chinese away on holidays, we probably haven't seen the full effect yet, and we are waiting for that. It looks like we will open lower today. The ASX is matching down around about 32 points to 52.03. It's probably going to be harder than that. Having a look at what's going on in the commodity space as well, there isn't a major support there, and even gold went backwards, as there is also reports coming out that the Chinese are actually losing their current demand for gold, and that really is pulling it down as well, even though you'd expect it to go the other way as people flight to safety and a store of value. So unfortunately not a very positive day. We are certainly watching the capital very, very closely. Any form of changes to the shutdown will be good. However, it doesn't look like coming anytime soon, and that means the debt ceiling is well and truly in focus. So be aware, we do expect some fairly volatile trading sessions over the next couple of days.